Hi guys, Whitney here. Welcome to the Passive Investing Made Simple show. I'm your host, Whitney Elkins-Hutten, Director of Investor Education here at PassiveInvesting.com. And I'm so excited you're joining me today. We do this show live every Tuesday to help you learn the ins and outs of passive real estate investing so you can go into your next deal with confidence. And so if you haven't done so already, be sure to check us out at PassiveInvestingWithWhitney.com. There, I've got some free goodies for you. And you also can get access to my calendar and we can talk about all things passive real estate. Now, before we dive into today's content, make sure to check out PassiveInvestingWithWhitney.com. Oh, by the way, you can see our open deals. So if you're a passive investor looking to place capital into passive real estate deals, you can do so there. All right, today we're going to talk about how to navigate passive real estate deal exits. And more specifically, how do we judge whether we should participate in a 1031 exchange in our passive deal or not? Like, there's no right or wrong way here, but how do you make this decision? All right. Now, before we dive too deep into this topic, if this is the first time you and I are meeting, again, my name is Whitney Elkins-Hutten. I'm the Director of Investor Education here at PassiveInvesting.com. And this is the whole reason why I invest in passive real estate, both in equity and in real estate debt, is so I can actually have time freedom and choice. And it allows me and my family to do what we want, when we want, with whom we want. And so my real estate career kicked off in 2002 completely by accident. I bought a house with a significant other, and then about a month later, the relationship fell apart and I had a house. I got very heavily involved on the active side of real estate, live and flipping and house hacking. Eventually decided, hey, I'm done swinging the hammer, painting the walls. I need to figure out how to do this flip one time and hold that real estate in my portfolio for the long term so it can generate cash flow and equity for me. Then eventually, after scaling up 36 single family rental units, it was time for me to move into larger deals so we could actually achieve our goals. And then over the past several years, I've been on both the active general partner side of multifamily and self-storage real estate, but also on the limited partner side. And, really, to fast forward to today, I've been able to scale 6,500 residential units, 2,200 self-storage units, 15 express car washes in partnership in our portfolio. This is just me personally. But this, as a passive investor, which is probably why you're here listening, these are just vanity metrics. Again, what you're after is the result, is how can you scale a portfolio that will allow you 100% freedom of choice of how to spend your time. Now, here's the cool thing. I love talking to investors, educating investors. I love spending my time here with you, helping create impact in your life, because if I can help free you and free up your time, we're just going to create a ripple effect in the world. All right. And we can help you do that here at PassiveInvesting.com through our debt investments with our real estate debt fund, or in our equity parts of our portfolio. We have very strong returns to our investor and strong growth over the past few years. Now, what we're going to talk about today is 1031 exchanges. Should we do them or should we not? And when it comes to a passive real estate deal. But nothing I should say today, it's all education. It should not be construed as financial, legal, or tax advice. So make sure that you take what you learned today back to your real estate investment team and make sure that it applies to you in your situation. Okay, so we really have to kick off today with just the bare basics, like what is a 1031 exchange, right? We have multiple ways we can exit a passive deal, but I think the one that most investors are probably attuned to, especially in real estate, is the 1031 exchange. But it is actually a quite complicated tax maneuver to accomplish. And here's the thing, a lot of people actually don't get involved in the passive real estate side of things because they actually tell themselves, I'm not going to make that higher return. If I want to take advantage of the 1031 exchange, if I want to actually utilize the tax, the tax deferment, laws here, the tax code to my advantage, I can't go into a passive deal. There's just no way I can do it. I have to do it on my own. And guess what? I don't want to. I don't want to be that active in my real estate. And here's the thing, that's not true. You can be in a passive deal and still take advantage of the 1031 exchange. Okay, so what is a 1031 exchange? Well, let's do a little bit of history here. So back in 1921, we got our first tax code. Okay, and that's when the 1031 exchange was actually introduced. But it has morphed and morphed over the next 3 years, and we actually got our current version of the 1031 exchange in 1924. Okay, and in the tax code at that point in time, the 1031 exchange allows for a like-kind real estate asset exchange in order to defer capital gains and depreciation recapture on the sale of an investment property by exchanging. So when you sell the property, you just exchange it for another property of equal or higher value. Okay, and we'll talk about why that happens, in a little bit. Okay, so essentially it's like playing Monopoly, right? You buy a house, you get 4 houses, and then like you can sell the houses, but you can't like go sell the houses and pay one house all in cash. No, you got to trade up, sell those houses into a hotel, right? But here's the trick. In order to take advantage of the 1031 exchange, right, it can be in real estate, it can also be in business. The properties or the businesses must be like kind, okay? And the proceeds from the sale must be held in escrow by a third party and used to purchase the new property or the new business. So you can't sell a piece of real estate and then go exchange it for a business. And you can't sell a business and go exchange it into real estate. Now, before, a lot of people here that might be sitting on 1031 exchanges or thinking they're going to do a 1031 exchange before the end of the year, there are ways called a tenant in common that we can actually help circumvent that exchange from business into real estate. So we're not really going to dive into that in the meat of today's presentation, but we can certainly tackle that in our Ask Me Anything part of the show. So again, the thing is here, real estate for real estate, business for business. At the end of the day, this 1031 exchange, the reason why it's so powerful is that the IRS is incentivizing you as an investor to show you where it wants you as an investor to solve problems. In this case, it wants you to solve problems in the area of real estate as an investor and in the area of business as an investor. So it's essentially incentivizing you to keep your money. You already invested in one property. Let's keep it invested there and continue to buy more and more property to solve more and more problems. Now, the 1031 exchange actually is the process is straightforward. Okay, there's laid out steps. Okay, we're not going to go into those steps because again, we're here as passive investors. We're not here as active investors trying to do the 1031 exchange ourselves, but it can be really hard. Okay, so in order to execute a 1031 exchange, usually the best time to do a 1031 exchange where you can get the most money means you're selling high, but it also means you're buying high. Okay. It can be difficult because there is a time schedule in which you have to find a replacement asset. Meaning, I sell an asset, I'm going to place it at that the profits, the gains in escrow. I'm not going to touch them. I can't touch them. Okay, I'm going to place them in an escrow with a qualified intermediary, and I have 45 days to identify a new asset. Now, if I'm smart, I've already been shopping. Okay, but I have 45 days to identify the new asset or assets, okay, that are going to qualify for the exchange. And then I have 180 days to close those assets. Number 3, you have to spend up, meaning I can't sell like a pool of, say, 10 single family rentals and use that cash to pay off the other 5 that I'm holding and hold them all in cash and take advantage of the 1031 exchange. Okay, so I can't consolidate into cash position because now I'm solving less problems in the market instead of more problems in the market. I can't move from active real estate into passive real estate very easily. Now you can, and I'll touch on that here in a second. But meaning like if you have like a single family rental or a short-term rental and you go to sell, you can't just 1031 immediately into a passive syndication. You have to go through what we call a tenant in common position. And you can't necessarily move asset classes that simply, meaning you can't sell your business. Say you own a dental practice or an engineering practice, you can't sell that in like 1031 into real estate. Okay, again, we're violating that like-kind exchange clause that went into effect in 1924. But as I said before, 1031 exchanges, when you're in a passive real estate deal, can actually be a good thing. It can be a solution for you. So say you've already gone into a passive deal, you've already invested your cash. It is something that you should really take a look at whenever your deal goes to exit, okay? Because again, you can defer capital gains and that depreciation recapture, okay? And the reason why you should really consider it is because the operator is taking care of everything for you. They're selling the deal. They have to go find the suitable property for you. They have to manage the exchange intermediary, all the paperwork, all the 1031 exchange timeline. You as a passive investor don't have to touch any of that. The operator will actually manage all the accounting for you in that. Okay, so when it comes down to doing taxes, the tax return at the passive real estate level, at the deal level, okay, that'll all be taken care of, and you can just take the K1 loss, take it to your or the K1, I should say. Hopefully it still shows a loss. You're going to take that to your accountant. It will be applied into your situation. But the big thing here is it keeps your capital working hard with zero downtime. Okay, so for a lot of people, this can be a very viable solution. All right, and this is what it looks like to execute a 1031 exchange in a passive real estate deal. So, if say like we have a deal that's selling, you got the sell of the asset, okay, we are actually going to notify all investors via email that the asset is under contract to sell. You're going to be asked to complete a form saying, hey, do you want to do a 1031 exchange? Do you not? Okay. Now, here's the thing. If you want to do, don't want to do a 1031 exchange, or if you want to do a 1031 exchange, there's no further action needed from you. Okay. If you elect not to do the 1031 exchange, and then we actually do 1031 on a project, you're going to have a little bit more paperwork because you got to let us know where you want the funds. Okay, then step 3, we're going to let you know what asset has been identified to exchange into. Now, in step 2, that's essentially a soft commitment saying, yeah, I think I want to do the 1031 exchange. And you still get to look at the asset to make sure you want to do the exchange. Okay, now here's the big question that investors love to ask, and I totally get it, is they're like, okay, what is my tax liability if I do the exchange compared to if I choose to elect not to do the exchange? Here's the thing, it depends because it's based on your personal situation. So that is really a question for you to sit with your accountant on, and we try to give you as much information as possible so you can take it to your CPA. All right, and then step number 4, once we've got that asset under contract, we're ready to close. Okay, that is where you're going to take your initial investment and your share of the proceeds of the sale of the asset, and that's going to roll into the new asset. All right. Now, maybe for some people, 1031 exchange just doesn't seem viable. Maybe you need the cash back for some reason. Maybe you need to, adjust your portfolio because you're moving from accumulation phase into more of a cash flow phase, maybe a retirement phase. Maybe you need to do some rebalancing. There are needs, reasons why limited partners actually have to choose against doing a 1031 exchange. Okay, so make sure that you are talking to your CPA before making these decisions to understand the different impacts of these decisions. But I wanted to kind of wrap up and let you know that there are alternatives, okay? 1031 exchanges sound amazing. I love them. You as a real estate, passive real estate investor should love them too, but we need to know our options, okay? So assuming you're on the limited partner side of things, and you're not in what we call a tenant in common position, number 1, you could simply just take the cash and say, thank you very much. I'm going to go buy my boat, get a second home, go take that European vacation. You can consume the cash. You just need to know, partner with your CPA, understand the tax impacts of doing that. Okay, you could take your initial investment, any gains or and such, and go into a new equity position in a new asset, ideally within the same calendar year, and restart your depreciation clock. Okay, this is what we call the lazy 1031 exchange. And guys, I've covered this a couple times on the masterclass, so you can go to our YouTube page and find those episodes. I'm sure I'll be doing an updated episode here on the lazy 1031 exchange here in the upcoming few months. Alternatively, maybe you're just like, hey, now's not the right time. I need to rebalance. I need to move this money from equity into cash, or a more debt position, or I'm just not ready because of the market to go into another equity deal. That's fine. Consider taking that placement, that cash, and putting it into a debt fund. We have a real estate debt fund here at passiveinvesting.com, and that can actually keep your cash earning a return while you are contemplating your next move, or maybe that is your next move, is moving from some of your investment, rebalancing from an equity position into a debt position. So I just want you to know the 1031, while it's amazing for most investors, I myself love it, it is not always the best choice. You need to go through this hierarchy of choices and figure out what fits best for you. Now, as always, I want to invite you to take action. So make sure to visit passiveinvestingwithwhitney.com. There, you can jump on a one-on-one call with me, and we can talk through your passive real estate investing goals and how we could help you meet those goals here at passiveinvesting.com. And I also, if you haven't already, check out my book, Money for Tomorrow, How to Build and Protect Generational Wealth. That book there will also help you understand the various aspects of real estate and how to build and grow your wealth. Guys, we're going to move to the Ask Me Anything part of our show. All right, guys. I know for me, my daughter starts school tomorrow, so I know it's August is hit. It's a busy time of month, but I first want to just make sure that everybody was that useful. Okay, go over to your chat box. Let me know if that was useful. I always like to know, what did you love? What would you love to see in this presentation? And then also, let's get your questions answered. What kind of questions has this perked up for you or raised for you? Any questions? I'll hang out here for another minute or so. Let's see if you guys are typing. Quick question is, what is a tenant in common? Tenant in common is actually where somebody might have maybe you have a multifamily deal, or have a pool of short-term rentals. You've sold that property and you've decided to do a 1031 exchange, and it's sitting with an intermediary. You can actually go into, on some passive deals, what we call a tenant in common position. So you could actually invest into an entity, an LLC that you own, you control, and you would be underwritten into a passive deal on the general partner side of things, but that your tenant in common actually goes into what we call a special purpose vehicle. That special purpose vehicle moves your general partner interest from active real estate into passive real estate. So it's kind of a unique way to leverage a 1031 exchange and move from hard and fast active investing into more traditional passive real estate investing. Now, in order to set up those type of entities, it does take money. It probably costs somewhere between $20,000 to $25,000 to set up the whole structure. And so for our investors in our multifamily deal at $1 million or more, we can handle investors like that, or in our self-storage deal at $500,000 or more. Do you know any potential changes to the 1031 exchange rules? I would say every election cycle, which is like every 2 years, I feel like it makes amazing headlines to try to, the news loves picking up these type of things to, what is the Congress going to do to dismantle 1031 exchanges and depreciation and all that? I would say, I'm not well versed in all the rules out there, and quite frankly, it's because I stopped paying attention to them. These rules have been around since the first tax code in 1921. They were modified in 1924 and largely stayed. I mean, there's been some tweaks there, but pretty minor. Long story short, majority of our congressmen and senators hold real estate in their portfolio. I doubt they're going to like materially change the 1031 exchange rules because it's going to impact their own portfolios directly. That's my read on things. Okay, so anything can happen, but until you know, real estate kind of falls out of favor, you know, for all senators and congressmen as an investment vehicle, I don't really see those things changing. Can you talk about an experience with 1031 to other types of qualifying assets like minerals? I'm wondering what the other options are other than another multifamily property. So you know, minerals, I would imagine like real estate, it would be real estate for real estate, business for business. You know, I don't know about minerals directly. That is something that I do not invest in for various reasons. Now, what I can say is I can sell a portfolio of single family rentals. I can trade into a multifamily property. I can trade into short-term rentals. I can trade into self-storage. I can trade into a mobile home park. I can trade into anything that's real estate. Okay, so yeah, it doesn't have to be for like another multifamily property. Okay, it can be anything that can qualify as real estate. I had Dave Foster on the show about a year and a half ago. He is runs the 1031 investor. He's also a qualified intermediary. He actually, you know, said that there's a way that you can 1031 property and actually eventually make it a property that you can utilize for personal use. Okay, like just blows my mind. There are a lot of things that you can do here, so it does pay to get a professional to help you out if that's what you're going to do. Like say you have personal property you're going to sell, I would say get a professional to help you navigate what your options are, for sure. Another question is like, what happens if your 1031 exchange falls through? Now, again, remember, we're talking from the perspective of a passive investor. Okay, so let's say we say, hey, partner, limited partner, you've been in our deal for the past 3 to 4 years. We're going to sell this property and we're going to pursue a 1031 exchange. You want to participate? We identify a property, and for whatever reason, it falls out of contract. Then you would, if we can't identify another property, say if our 45-day window is still open, we could still identify another property. And that 45-day identification window has closed, then we would just, take the cash like anybody else. So yeah, none of that is necessarily passed through to the investor. Personally, I've done done a 1031 exchange, been successful. I've also done 1031 exchange where I couldn't find a good replacement property. Guys, remember, you don't want to do a 1031 exchange just to do a 1031 exchange. You want to do a 1031 exchange into a great property. You still want to get a good property. I couldn't identify anything. I was out my fee. Okay, it was about $800, but it was a good maneuver for me because I had the potential to save like thousands of dollars. Can you get into oil and gas or mineral rights with 1031 from a single family asset? We already had that question. Don't know. That would be something that I would talk to a qualified intermediary. I don't know if it doesn't make sense in my head that you would actually be able to do a 1031 exchange, but oil, gas, and other mineral rights have other huge tax depreciative bonuses to them. But you have to know your investing goals. Like that, from everything I've seen of what's in the market, I'm trying to, be gentle to oil and gas and mineral rights. I mean, that's my dad was in that industry, so I'm a little bit more versed than a lot of people. Long story short, you know, most deals in the oil and gas and mineral rights really only produce on the tax benefits, very little on the capital. I would say cash flow and equity growth remains to be seen on the capital preservation, which I don't invest in deals to get a tax benefit. I invest in deals to preserve my capital, get cash flow, get equity, and the tax benefits are just bonus. So, but you have to, it goes back to, you have to know your investing goals, okay? Your risk that you're willing to take to achieve them, your timeline that you need to, and that is what's going to inform a lot of that. All right. What other questions do you guys have? These have been great. Somebody asked, where can you find the tenant in common video? Yep, that would be on our YouTube page. But again, I'm going to be redoing that video because it's been a couple years since we talked about 1030 or tenant in common relationships. Oh, right. Yeah. So somebody, just clarified here, if you lose out on all your potential or 3 replacement properties and not be able to close, you only lose your fee. There's no IRS penalty. Yeah. If I implied there was an IRS penalty, I don't believe I did, but if I did, I did not mean to. But yeah, there's no penalty other than losing out on your fee. And then of course you have to pay the gains and, your capital gains tax. But there's no real penalty like to doing it. It's if it's something that you want to do, it is definitely viable to try to go for it. Just most of the time when people sell property, even operators, they're selling at the height of the market, which is also the worst. It's the best time to sell a property, but the worst time to try to do a 1031 exchange. And so you really have to be kind of like cognizant, what is that property that I'm going into, for sure. And here's another kind of thing to chew on, guys and gals, is we still have 60% bonus depreciation this year. Okay, it is set to tick down to 40% next year. Taxes, you can still get your effective tax rate pretty low through accelerated depreciation, bonus depreciation. So if you have not identified a good asset to go into on your personal exchange, if you just despise the replacement asset that the operator has picked, you can get into another deal before the end of the year, a lazy 1031 exchange can be a very viable option. Once we drop below kind of like that 50% bonus depreciation, the 1031 really starts making a lot of sense again. So we're kind of at that break even threshold here. Awesome. I'll hang out here for another minute. As always, thank you so much for taking the time out of your day to spend it here with me. And not only that, but investing in yourself and your knowledge. If you ever have any questions or if you'd like to see a topic covered, you can ping me at whitney@passiveinvesting.com. I would love to tackle that topic for you. As always, thank you for joining, and we will see you next Tuesday.